2022 is drawing to a close, and this week we're looking at the stories that have defined a tumultuous year. In the world of finance, the cost of money continues to creep higher as central banks around the world raise interest rates to wage war on soaring inflation. What does this mean for businesses and investors heading into 2023? Will it hamper global economic growth? Your analysis with a couple of experts is up next, but first, let's take a look at the state of play in 60 seconds.
Central bankers accelerated trillions of dollars of unfunded government spending during COVID times and had to pay the piper in 2022 amid runaway inflation. The Bank of Korea might have been the first major economy's central bank to lift interest rates in August 2021. But the US led the way in 2022, raising rates by more than 400 basis points. Canada, New Zealand, and Australia have followed suit. The steep rate hikes by the Fed caused a major correction in US equities, with collateral damage to other stock markets around the world. And that led to the US dollar strengthening against most Asian currencies. The Japanese yen's weakness peaked in October, partly thanks to interventions by its finance ministry. But not all followed the absolutes of the Fed hikes. The People's Bank of China actually cut rates to deal with a property slump and an economy wrecked by COVID-19 lockdowns.
We're very pleased to be joined today by Nathan Sheets, Chief Global Economist at Citi. And we also have Steve Cochrane, Chief Asia Pacific Economist at Moody's Analytics. Nathan, let's start with you first. We've seen central bankers this month in particular talking tough on policy making in order to provide space for further rate hikes in 2023. But there's also the thought about how we're seeing peak inflation. How much more complicated does that peak inflation narrative make policy making, especially as we are still unclear on underlying inflation?
Well, in some sense, we may be seeing peak inflation. But what's also true is that the level of inflation right now is very high. And the central bank's sense is that such high inflation is a threat to their credibility. And even if it's going to come off a little bit, they can't wait. They feel like they need to move preemptively to address the inflationary pressures and to do everything they can to get the inflation that we're seeing in various economies around the world back down closer to their targets. But they still have a lot of work to do in that regard. In Europe, the gas shock's still very much in play, and that's pushing up inflation. And in many other economies, it's tight labor markets and rising wages that are pushing up services inflation. So there's still a lot of inflation out there. The overall level of inflation is too high, and that's what the central banks are reacting to.
Steve, let's bring you in here for a look at Asia. I mean, we heard from Nathan. He talked about services inflation that's still high. It's pushing up core inflation. It's at multi-decade high levels in many of the major economies of the West. Is that taking hold in the Asia Pacific? Do you see that happening? Stickier forms of inflation taking root in Asian economies?
Well, I think it's a little bit different in Asia. The overall trend is quite similar. Inflation is still quite high. If you look at the top line inflation, it did seem to peak across most of the Asia Pacific region about 2 months ago. We're seeing it come down a little bit. That's a good sign. But homegrown inflation, aside from the supply side pressure, is still there, particularly food inflation. Food prices are high and still rising. And this is a concern for central banks around the region, particularly in the emerging markets of Asia, because food is such a large component of the consumption basket. So central banks in the Asia Pacific, they're going to be very, very focused on this as well. And we'll certainly see, I think, some continued tightening of interest rates going forward over the coming several months to make sure that inflation is contained here, as well as it hopefully will be elsewhere in the world.
Nathan, what Steve refers to is really about this double whammy for consumers. They're getting hit by higher borrowing costs, but also higher prices for things like food or energy. How is that changing the way that people think about their savings, their retirement plans, their long-term investments?
What's been quite surprising is that so far the global consumer has been quite resilient. And notwithstanding this double whammy that you describe and all the accompanying economic uncertainty, consumers globally, and there are some important exceptions like China, which has been driven by unique factors. But broadly speaking, the global consumer has continued to spend quite vigorously. And I think part of it has been they accumulated significant savings during the pandemic. And those savings are being drawn down, and that's supporting expenditure. And of course, another key factor is this labor market tightness that I described that's contributing to the wage inflation that the central banks are worried about. That very wage inflation and labor market tightness, for the moment, continues to put a fair amount of income in consumers' pockets. So given all of this, the toll on the consumer globally has been less pronounced than what we might have thought, given some of these other developments.
Okay, Steve, I'd like your thoughts. I mean, even as we talk about the consumption side of things and the stronger consumer than expected overall, we've also seen how policymaking has changed for central banks, for fiscal policymakers as well. And this year, it's unlocked that tightening. Do you think this is a paradigm shift that we're seeing in the Asia Pacific, given the way central banks are going about doing things, especially since this week we've seen the Bank of Japan tweaking its yield curve control program, and that's raising speculation that we could see it depart from a long-time policy?
Well, first of all, aside from Japan, the other central banks are moving in very similar directions. Just this week or last week, the central bank in the Philippines raised rates by 50 basis points. I expect that I think it's today the Bank Indonesia will be meeting. We may see a 50 basis point hike there, and after that, we'll probably see central banks continue with smaller hikes, perhaps 25 basis points, 1 or 2 hikes as we get into the first quarter of next year, partly to keep pace with the Federal Reserve so that interest rate spreads don't widen too much between this part of the world and the United States. That also should help take some of the pressure off of local currencies, given the dollar strength. It's been so troubling for currencies in this part of the world. Now, Japan is interesting. It seems as if this surprise move by Governor Kuroda and the Bank of Japan may signal a change, but I'm not so sure it's really all that clear. One is that the move is a very small one. It expands the corridor in which interest rates can move. Instead of 25 basis points, 50 basis points. But at the same time, the central bank announced an increase in purchasing government bonds, which it has an opposite effect on the economy and on interest rates. So it doesn't really look like there is a significant shift in policy, and I think markets have recognize that. If you look at the yen, it strengthened initially on the 20th of December when the announcement was made, but the yen is back where it was before the announcement on the 20th of December. So I don't see any significant impact in financial markets or even more importantly in the real economy in Japan.
Okay, Nathan, just one final question before I have to let the both of you go. Do you agree with what Steve's assessment of the situation is that, next year we're likely to see more of the same in terms of that level of tightening, especially as Nathan, you earlier raised that we're seeing a strong consumer. This paves the way for further rate hikes. Is the era of cheap borrowing then well and truly over?
So my sense is that through much of the first half of next year, we are likely to see further rate hikes from a number of central banks around the world. Now, that said, as you get toward kind of mid-year, I think at that point, the level of rates is going to be sufficiently high, and likely also some signs of cracking in the inflation process. And at that point, I think central banks are going to feel comfortable putting rates on hold through the second half of the year. Now, that's much different than what the markets are pricing in. They're still expecting rate cuts during the second half of next year. So I think there may be another surprise in the second half, but it's more the central banks persistent in their type policies. And I do think that these higher rates are likely to put a crimp on borrowing going forward. I mean, frankly, we're already seeing that in a very pronounced way in the U.S. housing market, which is one part of the economy that's starting to slow.
It's changing things for a long time to come. Nathan and Steve, thanks so much to you both gentlemen for sharing your analysis and your time with us. Much appreciated. You've been hearing that from Nathan Sheets of Citi and Steve Cochrane of Moody's Analytics.